Hi, this is Don Debelak. You've reached the seventh video in the series You Have a Product. It's called funding. It's not necessarily an insurmountable hurdle. It's that most inventors think it is. If you do it right and you get your funding in line, you will find that you can get it in place and on time for you to really successfully introduce your product. Now there's some other financing videos that I have included throughout the section. I've put them some of them are a little redundant to this one, but I put this one in here because a lot of people might just go straight to You Have a Product and ignore some of the other videos series, which are more about people who are starting out with an invention from the start. But as far as the other videos, going forward, preparing for sales, video 8, obtaining funding, is probably the best one that explains how to go about raising money, getting shares, setting a valuation on your company, and just generally kind of getting all your ducks in a row really to approach investors and get them to help you. Going forward, preparing for sales, video 3 is about creating a detailed funding plan which takes into effect what you do to get your product started, getting patents, prototypes, etc. Then what you do to get into your beachhead period, getting enough money to actually establish that your product can sell and that it can be successful. And then in creating an introduction plan, which is one of the videos right after Before You Spend Big Money, video 7 deals with financing. So we have talked about financing throughout these videos. If you haven't seen it, going forward, preparing for sales, video 8, obtaining funding is probably the best one for you because it really details how to set up an equity position. I'll have some slides later on that I've taken from that video series just to give you an idea of what's really necessary if you're going to go forward and raise money from investors. Types of funding that you have, and if you have a product, you've probably already done a lot of this. You have money from individuals, which includes yourself, money that you get from manufacturers. You're arranging agreements or deals or partnerships with manufacturers in order to try to get some funding out of them to help you. Same with distribution. Maybe you've given an exclusive agreement. Maybe you've given a 1-year priority to that manufacturer. Maybe you've promised not to take any new distributors towards a certain market in return for getting some upfront investment. You might have gotten some money from crowdfunding. It's becoming increasingly popular, more on the rewards-based crowdfunding where you actually, people give you money and then when you have products ready, you ship them to them. But you can also do just sell shares over crowdfunding, but it's really kind of cumbersome and difficult and you really need an attorney to do that. If you have resources, once you've gone through the period of a beachhead where you've got some established sales success and you have some agreements maybe with the manufacturer or with the distributor, you might be able to get bank loans, SBA loans, private placements. Now, there's really two kinds of investments. If you only have about 10 to 15 investors, and some of them are what they call accredited investors, which means they make more than $1 million a year or they have $2 million of assets, then you can actually just have just your own private sale. A private placement is where you're going out and selling products, selling shares to people you really don't know, and it's a bigger fundraiser, usually about somewhere between 2 and 3 million. When you're doing your sales to individuals, a small number of individuals, there you might be raising $200,000 to $1 million. The cost of doing private placement, attorney and legal fees are pretty high. So if you can avoid doing that, that's good. As I mentioned, crowdfunding, besides just with the reward base, you can also get crowdfunding where you're selling shares. But be sure to do that with an attorney. You can get venture financing from venture funds. They rarely would do funding for a new startup, but if you really are in an exciting area, you might be able to raise money from them if you've gotten quite a bit of market testing and established a beachhead and have really good partnerships set up. And an IPO is just an initial public offering, which most inventors aren't ready for 3 or 4 years. This is where you actually go out onto the public and sell stock to just anybody without any really limitations. Again, lots of legal fees for that, and it's really not what you're going to want to do to spend your money until you really are successful in the marketplace. Money from individuals. Well, the number one source of money for most is self-funding, family and friends. A lot of times, if you've followed the networking strategy and gotten industry helpers lined up, you might be able to get some funding from them in return for them having to share at stock options later on. Angel investors, this is what I was really referring to when I was talking about, getting the smaller investors, maybe limiting yourself to 15 investors. Usually angel investors, they might be accredited, and you need some of them to be accredited, but not necessarily. And of course, crowdfunding is just where you go on a site like Kickstarter with a really great video. You put it on there and you tell people if they give you $100, you'll help launch your product. And once your product is ready, you will send them maybe 1, 2, or 3 of the products for their own use. Now, money from manufacturers, a lot of times inventors don't think of this, but the manufacturers have a lot they can offer you. And basically, manufacturers have a lot of benefit when they're dealing with an inventor. If you can add 10 or 15% production capacity for the manufacturer, raising up his volume and his plant utilization, they're going to make a lot more money, not just on your product, but also on all their other products. So don't be afraid to try to get some money from manufacturers. You can get it in-kind investments. This would be help in designing your product, doing your drawings, working on the specifications, making prototypes for you, are giving you some low costs when you're going through low volume production. It could be furnishing some tooling for you. They can also give you extended terms. Inventors are always forced kind of into a box, because what happens is you have to buy raw materials and start production. Well, you might not get paid for the final product for 6 months because the production will take so long. You'll sit in the warehouse so long, you have shipping, and then you might not collect after you ship for 30 to 60 days. So extended terms from your manufacturer really cuts into the amount of cash you need to introduce your product. Amortized tooling, this is where the manufacturer pays the tooling for you up front, but then charges you a premium on every product you pay until that tooling is paid off. That's a really big benefit for the inventor, because in effect it's a loan to you that you pay off after sales of products. Again, as prototypes, product development, any engineering service that they can give you. Sometimes you can get an outright investment from your manufacturer, can own part of your company. And sometimes if the manufacturer really likes your idea, he's going to be taking a looking at joint venture funding. Now, one of the problems with manufacturers, and you're going to have to learn this, is they're always happy to deal with you. They're always happy to make your product. They're always happy to take your money. And you really don't know if they really like your product or not. Well, once you start getting the manufacturer to kind of kicking in with some investments, then you know he likes your product, and then you're in a better position really to move forward. Money from distribution channels. Well, you can have cash deposits, prepaid orders, quick payment terms. Maybe the companies, the manufacturer, the distribution channels will pay you in 10 days rather than 60 days. Often you can get them to make an outright investment if you give them extended terms or some other benefits, and then you can also get them to give you upfront money in return for maybe paying you like 25 cents or 10% less for each product they take until maybe they've got 1.5 times their investment back. Again, sometimes they want a joint venture agreement, but often if they want a joint venture agreement, this is because they're a little bit worried about you surviving, and they might really like your product, but try to see if you can maybe turn that into a license, which is a better deal for you. The joint ventures always run into, it seems, legal differences of opinion where you're kind of fighting the manufacturer, your joint venture partner. And again, as I mentioned earlier, you can get a payment for exclusive distribution rights, or you can get upfront payments for agreeing to give a manufacturer a 3-year contract that they'll be the exclusive manufacturer for your product. Money from crowdfunding. I mean, this is really becoming more and more popular. Sites like Kickstarter, Indigo. There's many of them on the internet now where you put on your product, get on a really great video, which is usually about $5,000, and make sure you have a really good prototype. And you put a video on Kickstarter and you tell people how much money you need and how much money you get and how much you're willing to, how many products you're willing to send to them. Pebble Watch is a watch that competes with the Apple Watch. It raised $20 million on crowdfunding, and it was all what they call rewards based, where is rather than giving shares to the company, what you offer people is they can have some of your product once the product is introduced. Coolest Cooler is another company that really got a big launch out of crowdfunding. I believe they were on Indigo instead of Kickstarter, but really the two groups work very similar. So offer a product that's reward basing, offering shares, then you're into a whole other bag of worms with legal requirements. But you need an exciting video. You need something that really generates interest. You need something that appeals to the target customer. The drawback, of course, if you put in you're trying to raise 400,000 and you raise 300,000, well, then you don't get any money. All the money goes back to the people. So it's very, the costs are pretty modest for seeing if you can get out there and get the money. And usually it's young people who are invested in these products. So if you have a young person, I think of like the product, the hoverboards or something like that, you really will be able to raise money on crowdfunding. Now, banks and SBA loans, most people don't think that's for inventors, but actually, once you get your product out, once you actually have a successful sales period, once you have your manufacturer signed up, and once you have a distribution agreement in place, the banks, you can approach the banks. Typically, they require a 20% down payment. You really want to work with your local small business development center in preparing a business plan or bank documents. First of all, they know a lot about grant programs that are in your state. They know about low-cost loan programs in your state. They'll know about special incentives that are offered either by towns or the state itself or regions of the state to help you get going. So just be sure to check them out just to see what your options are in your state. In some states, you really can get a lot of money to help you get going. The thing about banks is they, of course, want you to start paying back the bank loan right away. And that's sometimes hard because you might not actually have that money to pay back for a year. So you have to borrow enough money or have a contingency plan to pay the bank back for the first year. But it's great because you have control. You don't have a partner. You don't have to worry about what other people are saying. You can really just go forward and control the whole process yourself. Sometimes the banks will allow you to use assets such as a home or have co-signer with assets to get started, so you don't always have to have the standalone on your product. So if you're thinking about self-funding a product, you're thinking about putting up your house for equity or doing something else, be sure to go back to the SBDC and see if you can use your house really to structure an SBA loan so that you don't have nearly as much risk. Now, selling shares, this is what I was talking about where maybe we're only raising, in this case, we were raising $150,000. Maybe we only have 10 to 15 investors total. Well, a private placement or other things are too expensive. So you can still raise that money as long as you don't have more than 10 non-credited investors. But be sure to use a local attorney first, because what's going to happen is that every state has different rules and regulations, so you don't want to run afoul of whatever your state's rules are. Again, the small business development centers can help you. They can tell you where the lower cost legal advice is. They can tell you about any state programs that people are offering to get your product out there. So here's kind of an example in an equity position. This is an inventor, Jerry Matthews. He has 250,000 shares. He put up some initial money. He was the founder, and he's really kind of run the system from start to finish. Stock sold for 30 cents. Well, that would have been the stocks where he sold when he was just trying to make prototypes, patents, and get that real initial stage started. Then you notice he goes on to selling stock for 75 cents. So this means he's got his patent, he's got his prototypes, has some production, and he's preparing for like his sort of beachhead period where he's just going to get some small markets really running and get some revenue, and then he needs to sell shares at $2 per share. So this is sort of an equity chart that shows how the product is evolving. Now, sometimes, but not always, you get some complaints because actually those 555,000 shares means that he's valuing the company at 1.1 million. And but I wouldn't feel too bad about that because as long as you're showing growth, you show you have a big market, you show that you've actually done market tests and you've had some sales beachhead, that number's not going to look too outlandish as long as you can show that in year 2 or 3 you could be selling over $1 million of product. Again, a private placement, it's a stock offering. It's a stock offering to people you may not necessarily know so well, but it's not with a public company. So you're not public, but you do have shareholders. Now, this is sort of a gray area, and another reason I like to have attorneys involved, because the way the rules rate, you're not allowed to go out and solicit investors for your product and to get shares. You're not supposed to do that. But on the other hand, if nobody did that, how would they get money? So basically, there's groups of people, and this is why I'm saying you should be going to your entrepreneur clubs and your chamber of commerce and other organizations, because you need to learn about people who kind of work with the companies like yourself and take your product to investors that they know in the community. So an individual who does this might have 50 or 60 investors, and they're the ones who really typically go out and sell the private placements. Now, of course, you pay on a private placement. First, you're going to pay attorney fees that are probably going to be over $100,000. And second, you'll pay this person who raises money about 10% commission. So there's a heavy price to pay to get this stock. So you don't want to jump into it too early. It's much better to go with kind of your own private little share sales than it is to do this. But there comes a time when you need more money, and this is the way you might need to go. So you need accredited investors. And of course, as I said, you may not know these accredited investors, but there are these investor finders who you can contact, and they're in almost every town. And work with them if you are going to take this route. Usually these investor finders have 4 or 5 key investors who take a position, and then once they take a position, there's smaller investors that come on board. And so if you have any local venture funding conferences, local inventors clubs, local entrepreneur clubs, contacting your local SBDC, you should do all of these things so that you have a chance to meet these people. And don't forget to have legal advice on any kind of stock sales. This is an area where you can get in big trouble if you don't circumvent any of the rules. Venture funding, as I said, usually they're more interested in investing $20 million and up, and they're really not that interested in getting started with a startup. But if you want to check them out, you can go to prattsguide.com. Large area libraries in your area will have a subscription too. I mean, you may not be able to go on to Pratt's because they'll want you to have pay a licensing or membership fee. But go to your larger library and they'll have that subscription already, and you'll be able to look into it. Also, your university, if you have a big university in your town, their library also probably can help you. So usually, though, this is for a huge technical market, strong patent positions, and I'd say in most cases, inventors who are listening to this video aren't really in a position to go after venture funding. And the last is just initial public offerings. I mentioned this only so because it's one of the options that your goal is to be able to have an invention go into the IPO in 2 or 3 years or 4 years. And often when you're taking on early investors and you're raising the money with shares, selling shares earlier, your exit strategy or the ways to get out, people say, well, I'm going to have an IPO. And once you have an IPO, then things go very well for you. I recently was with an invention company where we did well, I was not really an invention company, but it was a company that was introducing a new product for water treatment of oily water. Well, we raised $3 million from two investors, sort of in our own sell of stock, and then the founders had some shares of stock. But then once we got to a certain point, we did do an IPO, although it was really a reverse merger with an existing stock company. So it was sort of a modified IPO. But we were able to do that, and everybody who was an investor really made about 15 times their initial investment, and it was a pretty good deal for everybody.